What's up, Damo?
All right, T.
All good, all good. We've got some listeners' questions today.
Let's get straight into it, mate.
Let's get into it. We've had a few questions from our listeners about this current volatility in the markets this year. For example, what's the approach when things go bad in the stock market?
What's my approach?
Yeah.
I'm probably a pretty bad person to ask about this, to be honest. Volatility, schmolatility. The reason is because I'm kind of long enough in the investing tooth now to sort of not be fazed by these things, to the point where I don't even realize they're happening a lot of the time. You know, from someone who's like a social media person about the stock market and finance, I tune it out so well that, you know, I find out from the audience, oh, it's dropped a lot today. I'm like, oh yeah, well, yeah, it really has. For me, it's not really that much of a concern. It's not surprising because these things are part of the market. I think, you know, if you look at the S&P 500 on a long-term chart, about a third of all years are declines, and quite a lot of those are significant. It's more likely to get a minus 20% decline in the market than you are to get the average rate of return of 10% in a year. Do you know what I mean?
Yeah.
The drops are normal. So people need to internalize that first of all. And then I would encourage you to think about investing, not in terms of what is going on right now, but what is my timelines for investment. So for most people listening, they've got decades ahead of them. So they're sitting there going, okay, well, drops in the market are good. If you're running away from the market when it's declining and you've got 30 years ahead of you, you're running out of the store when the sale is on. Yeah. You know, you should be running into the store when the sale is on, because the declines allow you to buy units of the market for a cheaper price than you could yesterday. If you are nearer to retirement, obviously this is a different concern. But your plan for retirement should start 5 to 10 years before you retire. And part of that plan is accepting that there's a chance that at the point of retirement where you enter into retirement, that the markets might do badly, and you've planned around that. You've got cash buffers, bond ladders, annuities, these kind of things. I think, you know, it's just that preparation that needs to happen. In a way, if I was retiring in 5 years and the stock market was crashing now, I'd probably be a bit happy about it, because I'd be like, well, hopefully it's recovered a bit by the time I actually do. What I think is more interesting about this decline at the minute is that it's American-led, it's tech-led, and it kind of rocks the idea that, you know, all you need is the big tech companies in America. I mean, I hate to say I told you so, but I'm going to say it.
Literally like global fund, because we've been relying on America, been performing to continue performing as it has been for the last 20 years. And is that going to keep happening? So it's best to be diversified.
All it took was one orange man to come in and the whole thing, like, you know, fell apart. For
validation right there.
Yeah, well, I just think, you know, we're not talking politics, we're not talking about individuals or ethics or anything. All we're talking about is the fact that one man can influence the market so much, especially a person that everyone was like, oh, he's so great for the markets. He came in and everyone was having a great time. The markets thought this guy is going to be good for the markets. So the markets rose, even crypto did as well, right? But then because of his actions, everything is undoing a little bit at the moment. That could change long term, but what it speaks to is the uncertainty around performance, and also the influence that individuals can have on the market that are, you know, presidents, leaders, wars, these things can come out of nowhere. And the market can be pretty confident that someone's going to act in a certain type of way, and then they act in a different way, and everyone gets surprised. You know, I could say, we can sit here and say you buy a global market, but even the global stock market is underperforming or doing a little bit badly at the minute. You can't avoid these declines. And I think what people need to do is zoom out. So when these declines happen, they zoom out and they look at the chart and they look at the fact that actually it's still only relatively a blip. They also need to zoom out when they're planning their portfolio and go, what's happened today hasn't always been the case. And what I mean by that is American dominance hasn't always been the case. There have been periods of large declines in the American markets. So from 2000 to 2010, 11 was like a lost decade for the American markets. But I'd also say that zoom out and think, we probably needed this to happen, because the American markets have become so overvalued. Yeah. So have American tech businesses. They've become so dominant that this is almost like a correction. Yeah. The last couple of years have been great, but
it can't continue to go like that. It's not feasible, because
and it's like this, isn't it? It's ups and downs, and it's just a few bad days in the office. But if you zoom out and go over the last 3 years, the performance has been stellar, and this doesn't delete that. I mean, by the time this comes out, it might have done.
It might be better.
It might be worse.
It's like everyone says, like you said earlier, like people run away from the sale. Like I'm a big fan of buy the fun dip, BTFD, buy the fun dip or buy the effing dip. But there have been so many dips recently, my dip bag is exhausted. Like there's nothing left in the dip bag. Like you said, most people haven't been through one of these dips or corrections before, apart from all the people that have ever invested in crypto, and you'll be very familiar with this. What I would say is, if you have a good investment strategy, stick to it. When the market dips or when there's a crash, the way I don't freak out is because I'm like, I invested for a reason. I think that this is a good long-term plan. Like you said, like the dips are temporary. So if you can just kind of calm, take a step back, not panic, not, like you said, sit on the toilet selling everything because you've seen a dip, and you just kind of just breathe and just like take a step back and say, I think this won't last forever. It might last forever, but I mean, you've got to think realistically, is America going to disappear in the next like few years? Do you think America will come back?
Is that a question?
Yeah.
For me?
Yeah. Or do you think it's time for China?
No. I don't think it's, I think it's anything like that. I think the markets are a reflection of uncertainty. And I think, people are just selling because they don't know what's going on and things feel like they're changing. I think, a long-term bet on America, on the American economy is probably still as good as it was. It might even be better now because it's a little bit cheaper.
Yeah.
I think what's happened is that, the American markets have become overvalued by most metrics, and there's been an over-reliance on a few individual companies within that. And then you add in this kind of AI narrative, and people just love that sort of, everything's about to change. The amount of times that's been said over the last few years, AI, EVs, all this, and we're all still here wiping our asses with these. Like, do you know what I mean? It's the same. Yeah. The world doesn't feel that much different. So, I think this was a bit overdue, and corrections feel horrible to people, and they ultimately question if they should do something. I think what they probably need to realize is the media is really incentivized to make it feel really bad. If you just step back and zoom out and have a look at it, it really doesn't look that bad. My silence on the topic is reflective of what I think people should do, which is absolutely nothing. This is why I've not made any content about it, because I just don't want to feed into the panic.
There's so much news coming out, like it's all doomsday.
I think I will make a video and just be like, just chill out,
relax, tranquilo.
Yeah, what's that?
It means chill out in Spanish.
Oh, does it? How many languages do you speak?
Yeah, a couple. A bit Latin.
Tranquilo.
Tranquilo.
Oh, tranquil.
Yeah.
Yeah.
Good vocab. A bit of Latin as well. Got a bit of Latin in me. But you know what? Sorry, you asked me about languages. So I'm like a bit Latin, a bit French, a bit Spanish. But some people.
Any Nigerian?
I do Yoruba. It's a Nigerian language.
I'm a what?
You're Oyinbo. That means you're a white man. But yeah, I speak
Oyinbo.
Oyinbo, yeah. It's a term of endearment.
Is it?
Just racial slurs on the podcast.
What are you calling me here?
It's a term of endearment. What were we talking about? A lot of people are thinking that Trump is just kind of doing all these tariffs, crashing the market, things are going terrible. But after like 6 months, a year of like uncertainty, it could be a great time for America, because like he wanted to weaken the dollar. He's weakening the dollar. Lots of things have to go in the right direction, but it could be setting up for like next few years of like great returns.
I don't want to be pro or against Trump. I don't think that this is the place to have that kind of conversation. Go listen to, a politics channel. But what I think we can say is we're uncertain about the future. And, there's a world where what Trump's doing might work out, but in the short term, the uncertainty is what's causing choppiness, and people, in the short term, tariffs and things are going to make things more expensive for people on the ground and are bad for businesses because they can't, it's more expensive for them to do the things that they would do.
More expensive for the consumer, more expensive for the business.
Yeah, so and the markets are reflecting this. Long term, who knows? But again, think about timelines when you think about investing. Don't think about the day to day. And just because something was worth this yesterday and now it's worth that, don't think that prompts you to act. It doesn't mean you should do anything. One of the worst things that I see in my world is scammers who pretend to be me or the podcast and then try and get money out of people who follow us. And sadly, these scammers are getting better and better by the day. which is one of the reasons that we're really happy that we're partnering up with Vanta, who help businesses be secure and then prove that they're secure. Vanta automates compliance for stuff like GDPR, ISO 27001, SOC 2 and more, helping businesses build customer trust. The beauty of Vanta is they save companies a lot of time and money because proving you're secure without them really is an enormous faff. It can take months of work and form filling. Over 9,000 companies like Atlassian, Flow Health and Cora use Vanta to manage their risk and prove their security in real time. If you need to prove that your business is secure and compliant, you can get $1,000 off by going to vanta.com/makingmoney. I've left a link in the description for you.
Our next listener's question is from Mathilde. She asked, how do you reconcile wanting to invest, but also needing to save for so many life projects, holidays, house extension, wedding, etc.?
We can probably relate, right? There's always something you want to buy.
Always.
I think you got to kind of prioritize and realize you can't do everything. You can't have everything. I mean, I would love to be on all the holidays all the time.
I used to be.
Yeah.
Then I had a kid and now I'm like, I should probably save some of that money.
Yeah, I think, you're basically saying, I want to spend all my money, but I know I need to invest because you got to tuck away a bit. And I think the first thing you do is you pay yourself first and you go, I'm tucking away X amount for investments and the rest I can blow. And you give yourself a budget. And that money that you took away for investing, it's for your long-term future so that you can continue to go on the holidays and stuff. And you prioritize that. I put that ahead of all of the spending. And then the other stuff, yeah, I mean, you're probably better at this than me, mate, because, I'm like, how do I cancel the holidays so I can save more money?
Yeah, I mean, I'm meant to be going to Barcelona next weekend, but as you're aware, I haven't paid my tax yet. So I was like, I should probably pay my tax bill before I go on holiday.
You let the boys down last minute?
Yeah, I did. You know me, man. I hit a boy. I was like, I'm not coming. I'm not coming. Yeah, just because normally I'm always ready to go on holiday. But yeah, you've got to, as you get older, you got to just prioritize things. For me, like you said, pay yourself first. The investing is I've made it non-negotiable because I did so long of not investing and just buying what I wanted, spending, going on holiday. I'm like, yeah. And then I'm like, oh, Bitcoin will go to $1 million and I'll be rich. I don't need to invest. I'll just buy that. And then as you get older, you realize, okay, I need to actually be a bit more serious. So many of my friends are like how I used to be. They're like, oh, I'll figure out my pension later. Oh, my work could do my pension. I'm like, do you know what the investing is? Oh, no, but it's fine. So once you are, it's okay to be ignorant and you don't know any better and you're like, oh, I got money, I've got a grand, I'm gonna go spend it. But once you know I need to save for my retirement, my LISA, my kids' ISA, this investment, the market's gone down, I can get better value now. I just do my investments first. Once that's sorted, then I'm like, okay, what do I have left over? So for me, this month, it's do investments, pay your tax, and then if there's anything left over, you can enjoy it. But yeah, I think you just got to have rules and stick to the rules. Yeah, and you don't need to oversave, do you?
Yeah. I think it's 15% for retirement savings, including the matched contribution from your employer, dependent on your age. So as long as you're tucking away as much as you can, enjoy the rest. That's what you're meant to do, aren't you?
Our next listener's question is a topic close to Damien's heart. Ian wrote, you've mentioned in the past to avoid using robo-investors like Moneybox, who will charge high fees to simply put your money in an index tracker fund, and that it's easy to just do this yourself. But how? Using what platform? What process?
Okay, so, if you're not comfortable doing this yourself, there's nothing wrong with the fees are high for them to be a middleman. And what I'm saying is I think most people are able to do the process themselves. And my issue with robo-advisors or robo-investing platforms is they say, we take the complexity out of investing and we do it for you. And it's like, you're making it feel like it's more complex than it actually is. What I would do is, for every robo-investor, you can access what funds you're in. So when you click on the option, they'll call it like a balanced or owl or some kind of weird name. You click on it and you go through and it'll tell you what funds you're in. And you could literally just go and buy those funds. So if they're Vanguard funds that you're in, you go on the Vanguard platform and you buy them. Most of the robo-advisors and investors will be buying global indexes typically, and then some level of bond allocation based on the risk profile that you put yourself through. So if you said, oh, I'm worried about the stock market dropping and that, they'll put you in a more cautious portfolio. Whenever I looked at them, and this is going back years now, a lot of them were just Vanguard funds. So, you could go directly to Vanguard and buy the exact same funds yourself on the Vanguard platform and cut out their fee. So just go onto the platform, find out where the section is where it tells you what the funds are that they buy, and go direct to the person who provides those funds. Or if they don't, go and look at, Trading 212 or whatever. We keep a list of the brokers that we use in the description of every video. Those are all brokers that I use personally. Trading 212, Invest Engine, and Vanguard. So on one of those platforms, you'll be able to find the funds. Vanguard only sells Vanguard funds. So if it's like a BlackRock or something like this, Trading 212, Invest Engine, or any other broker in the UK, they're just charging you a fee to get in the middle of that process. It's like going to the wholesaler rather than going, to the corner shop, to Boss Man.
Boss Man. Yeah, I use Trading 212 and Hargreaves Lansdowne. Just because they're like, actually Hargreaves isn't that simple, but Trading 212 is pretty simple. But Hargreaves Lansdowne, they've got the prestige.
Reassuringly expensive.
Yeah, reassuringly expensive. I'm like, ooh, that's a bit of me. They're definitely going to keep my money safe. They're expensive.
They're going to keep it safe in their pocket, mate. Take all their fees. No, they're upping their game in a lot of ways. So like their junior ISA product is the best on the market.
That's what I got, yeah.
Well, there you go, because it's free.
Yes.
Reassuringly expensive. Look at you, mate.
Why do you always have to dig me out?
Funny, man.
They didn't know.
Oh, my broker at Hargreaves Lansdowne is your kid's broker, mate.
Free. But yeah, it's cool. And the lifetime LISA as well.
Oh, is it good?
Yeah. Well, I don't know. I'm gonna have to get you to check it out for me. Question from Bagasaurus. What are the easiest ways for beginners to invest in gold?
So I just want to caveat this by saying I don't really own any gold. I bought some gold once on the channel as like a little experiment, just some...
You got your little gold bracelet on.
Oh, yeah.
Yeah, he's got a piece of gold on a string. He can't afford the whole chain.
Piece of gold on a
so
string.
He just got the string.
Mine's real.
My gold's on a chain.
Yeah.
Yours is on a string. So there's levels to this thing, man. There's levels.
Yeah. So I don't buy any gold really for investment purposes, but I think that probably the easiest way is to buy a gold fund, like an ETF or an exchange traded commodity. You can buy them on brokers. Yeah, one of those, because you don't have to worry then about the storage costs and the safety. If you've got gold bricks in your house, you might get robbed.
Yeah, you're meant to store them in a warehouse, like gold bullion, but you have to pay, like you said, storage fees, so it does get a little bit annoying.
Yeah, so I was watching a video the other day, and it was like on TikTok, and it was like, oh, we found an abandoned bank, and we found silver in it, and they had all these silver bars in the drawers, and someone in the comments was like, that's a lie because silver tarnishes, so if that silver had been left there in open cases, it would have gone weird on the outside. And I was like,
yeah, because it's got to be like the right humidity and like the right temperature and all these things to like store the gold.
Yeah, I don't want to worry about all that, because you buy this thing as an investment, and then it's the price of it's getting it's got a cost to maintain it. Whereas if you buy a gold fund, the fees involved which pay for that, but you don't necessarily have to worry about that as much. I think it was the introduction. I was looking at this the other day. The introduction of the gold funds in about, I don't know when it was, 2004. Sorry, chat, might be wrong. Just a average Oyinbo here trying to get it right. But after the introduction of the funds, like the price went up a lot because like the ability to purchase gold became a lot easier. Kind of like the Bitcoin funds, like they thought they would expect the price to go up. Still waiting.
Tell me about it.
£1 million Bitcoin any day now.
Any day now.
But yeah, so that's the easiest way I'd say, because you don't have to worry about all the other things. But I guess the key question is, why are you buying the gold? Are you buying it because it's gone up a lot in price recently? Or are you buying it because it's part of your broader portfolio strategy? I'd really encourage you to ask that question.
They say gold is protects your wealth. It's a hedge against inflation.
Yeah.
Is that an old wives' tale, or is that actually a hedge against inflation?
I think there was a really famous paper, and that paper said that it is a good hedge against inflation, but only over long periods of time. So the point where it's not useful in the sense of you would do it for like family estates. Intergenerational.
Not for yourself.
Yeah, but then at the same time, people in the comments are going to be like, what are you talking about? Gold's done really well over the last few years. So maybe that paper needs updating. But yeah, I mean, the stock market tends to be a good place to beat inflation long term as well.
The next question is from The Giggle of Steel. Great name. Now that more than 50% of the stock market value is taken up by passive funds, and this is probably growing, is the market still as volatile and subject to extreme crashes?
Wow. So, first of all, the market has been more crashy since the year 2000 than it was previously. Remember the lady we had on The Economist, and she said that half of the major crashes that she'd studied had been post the millennium. So it's actually kind of more crashy, not less. And you would think that, or people might argue that if the market was passive, it would be less crashy because there's less people kind of buying and selling. But I actually think that the bigger trend that's maybe leading to the markets being a bit more volatile is the ease of purchase and sale. So the ability for retail investors who are buying passive funds, who don't really understand what they're buying or how the market reacts, they've not really internalized from question one that crashes are normal, have this ability now to get out of the market in an instant. They can see a news headline or a clickbait title and they can sell their whole portfolio in 10 seconds. In the past, there were lots of barriers to receiving information. You have to go and get a newspaper, or if you didn't walk past the headlines that day, you just wouldn't see it. Now you can't escape it on your feed, or you would maybe have to watch a certain channel. If you turned on the TV at the wrong time, you didn't see the news, kind of thing. And then there was you had to internalize that message, go away and go, okay, well now I'm going to sell, pick up a phone, call your broker, get through to your broker, who's then probably going to be like, try and talk you down and be like, you probably shouldn't sell everything. There's all these barriers that just allow people to cool down. Now, think about impulse buying products. I see a product on Instagram, buy it, it turns off. It's always a scam.
So much.
Always a scam. But that impulsivity in humans feeds now into the market. And I think that's probably leading to wilder swings because of the amount of retail investors in passive funds that they can just dump. We found this thing in The Economist. It's like this dystopian story that they tell that is sort of it's like the fable of active investors, where they describe a world that in 2034 here, they say that the whole of the stock market is just the Magnificent Seven, and Nvidia make up like 80% of the market and all of this stuff, and the threat that would pose to the economy. I think, what the active people don't say is the threat that they pose to people's portfolios is the extraction of fees. And that's a very certain risk. All these guys talking about how passive investing is so dangerous while they're creaming 2% of your portfolio off the top to not beat the market is just as dangerous. But anyway, 50% of funds are passive, not 50% of the market. People say this all the time, 50% of the market. No, 50% of funds. There's still 49% of active funds. And then there's a whole load of other people that are just buying individual shares, including most passive investors. I think there's a long way to go before passive investing completely dominates the market. Maybe it leads to some kinds of distortion within the market, money just flowing into the hands of the biggest companies and things like this. But they've been saying this about passive funds now since they were basically created. And lo and behold, they've just kicked the arse of active investors over that time.
It is in their best interest to try and drive people towards active because they're getting their commission.
Well, this is it. And, smart people like to think that they're smarter than the dumb option.
And you can beat the market and you're like, oh, I can...
The one thing that's going to annoy me is the 1 year, which will happen, where active investors beat passive investors, and they'll be like, "I told you," and it's like, you've been wrong for 20 years. You can't just go.
The one win you've had.
The score is 20-0. You scored one goal and you're celebrating. Do you know what I mean? It's like you've been battered.
But I think a lot of people most people start off like actively choosing their stocks and shares right when they start investing, and then move to passive funds. I think. So. They still they've got a lot of drive and momentum behind them. It's like everyone's like, oh, I can be smart. I know Amazon's good. Oh, I want to buy Netflix. I'm going to beat the market. And then...
This is a really good point, T. So, the assumption is that anyone who's active is somehow smarter and making intelligent decisions. How much of the active market is just people buying the hottest stock of the moment and distorting that price? Yeah. How much of Nvidia's rise has just been because people have seen the line going up and they've just got involved?
So many people told me, buy Nvidia. And I'm like, this is the first time you ever talked to me about investing, and you're telling me to buy a specific stock.
So it's funny telling you, where's your podcast? You know what I mean?
I'm like the cheek of it.
Yeah. Little baby T. Your capital T, mate.
Yeah, you're lowercase T's out here telling me what to do.
Lowercase T's. No, but it's a good point, isn't it? All these people criticize passive investing because of its passive nature and it just buys the market and it might distort the market. But if everyone was active and you just got people running around buying whatever's going up in price, is that not going to distort prices? Yeah. I think the biggest shift is just the ease of purchase, not the fact that passive funds are there. Yeah. I would rather every normal Joe, like every normal person be in a passive fund than be going, oh, well, I've got to actively pick. And I think what a lot of the active side of things is saying is, well, you need to pay us to pick for you. And I just don't see credible evidence over, a long time horizon that those guys consistently are good at doing that. We're not even answering the question here. The question was about volatility and choppiness. Since the rise of passive, it's become beyond 2000. I mean, it started in the 70s, really kicked off in the 90s, 2000s. The markets have been choppier. But you're going to blame COVID on passive funds,
You can't. There's a lot of factors, and especially the ease of being able to buy and sell. And like you said, like people used to get newspapers, but by the time it's printed, the news is already 12 hours late or whatever. Yep. And by the time you read it, it might be like the end of the day. So you're reading at 5 p.m. But we see it on I wake up and the first thing I see on my, I get messages on Telegram saying Bitcoin price, I get this, about Nvidia price, I get this. Just
about the California fires, whereas in the past you wouldn't have even known that was a thing.
Exactly.
Back in the day you'd have known the next village down. Now you're just a constant news feed of the world's dramas. Yeah. To quote Billy Joel, we didn't start the fire. The world's always burning. Since the world was turning. Yeah. So, I think it's the speed of access to information, the negative news cycle, and then people's kind of reaction to that and the immediacy that leads to more choppiness. Yeah. I don't think it's necessarily passive funds. One of the goals of personal finance is to take the money that we earn and to put it to work, so that one day we can hopefully stop working. But I often speak to company owners who have got plenty of money, quite large sums of cash, just sat in their business bank account doing absolutely nothing. So why not at least put that money to work? This is why I'm happy that we're working with Tide. They offer an instant access saver which I use as an account to generate interest on excess money for things like tax savings. New members can get up to 4.48% AER variable for 6 months. I say up to because it depends on how much you deposit in your account. The more you save, the higher the rate. You can get this deal, plus you can get £100 cash back if you fund your Tide Instant Saver account with £5,000 in the first 30 days. If you use code MAKINGMONEY. T's and C's apply. The code is MAKINGMONEY, all one word, or you can use the link in the description where you'll also find all of the offer and the full terms. The variable rate is correct as of April 15th, 2025.
Next question from Adam. I invest in the FTSE Global All Cap Fund via Vanguard. When does Vanguard meet to decide which companies are in the fund? When they switch companies in and out, how does this affect my investments?
So it's not Vanguard. Vanguard have a fund, a pot of cash that tracks the underlying index. So what Adam, is asking is, when does the underlying index change? FTSE, in this case, FTSE Russell, it's every March and September, it's twice a year. But basically they can meet every quarter, every 6 months, annually. There's lots of different...
But they change it twice a year.
In this case, but it depends. And if you look at the index, they'll say how often they meet and when they decide. And certain funds are much more kind of passive in their approach to this, where it's like if a company is of a certain size, it's in the index. Whereas other indexes, they take a bit more of a view. So the S&P 500, if you remember from our conversation with Toby Newbat, he was saying about how they'll weigh up a few things, not just the size of the business. They'll look at,
has to fulfill all the different criteria.
So it's kind of more active in a way. It's still relatively passive, but yeah. How does it affect your investments? Well, the idea is that over time, the losers fall out of the index and are replaced by companies that are growing at a quicker rate. You shouldn't see momentary declines. For to have a huge impact, imagine an Nvidia would have to decline significantly and fall out of the index. This would be huge. I can think of companies, say like an Enron. Imagine where it suddenly turns out that what is a huge company is just a fraud. Then you're going to notice a big impact. But for the duds to fall out the bottom, I'd say that they'd have been on a pretty significant decline for a long period of time. I can't really think of massive companies that are huge parts of the index crashing and burning in an instant. There was the company in Germany that was also a scam. I can't remember what that was.
Yeah, so it's mainly because I mean, even like BP did their big oil spill. They like polluted half the ocean, and they still stayed. You know what I mean? So it's like you've got to be doing something fraudulent, I guess, or, or performing really badly.
For you to like wake up one day and for you to notice this significant reaction in your portfolio as a result of a company leaving the index, that company would have initially had to have been a big part of the index because of the way that they're market weighted, like the FTSE global all cap. The businesses at the top make up a large portion of the fund. The ones at the bottom, so the ones at the bottom of the index are pennies.
Yeah.
So you've got like 1p in this business, say, and it's getting kicked out.
And then another company's coming in to replace that 1p.
It's not like Apple are getting dumped and then you would notice that. So another company's coming in. So the ones at the bottom of the index. So if there's 500 companies in the S&P 500, but the top 5 companies make up 25% of the index, you're sharing 75% of the rest of the pot of money between the other 495 businesses. So the ones at the bottom, who are the ones that are being kicked out, are literally getting pennies. Yeah.
Heather wrote in, could you give recommendations for older first-time investors with only 10 years until retirement? Recently inherited 20K to place somewhere, but where? Never had any spare money, so only state pension to look forward to.
No, I mean, you've got 20K there and you've got you've got a relatively long time horizon. So I think there's other things to look forward to. We did, where to put it. There's lots of options, pensions, ISAs, these kind of things. And it all comes down to your own personal circumstances, of course. We did a webinar with Lisa Conway-Hughes based on what to do in a lump sum and some of the options that I think could really help you, form your own idea around that. So we'll link that below and give that a watch. But, the basics are, do you have a good cash buffer, emergency fund? Are you maximizing pensions and ISAs and these kind of things? The common wisdom is that 5 to 10 years out from retirement, you start thinking about that approach to retirement. So that would be making sure, the cash buffer point, that when you start drawing from that income, that you're not kicking the portfolio when it's down if the market falls at that point. So yeah, I think first of all, just give yourself a break. There's lots of time there. 10 years, my life completely transformed in 10 years in terms of investing.
Mine in like 1 year.
There you go.
Pretty much like a year, yeah.
Yeah, so you can do a lot with 10 years and you've got a good base there in terms of the 20K to put it to work. Go on.
How much cash buffer do they need, or how much?
It depends. It depends on what their spending is, and I think the other point is the sequencing risk around taking money out of the portfolio at the point of retirement, and if it dips, it really hurts the portfolio long term. So most people will look to have some form of mitigating strategy that they can lean on, so that they don't do that. If the portfolio dips, they don't have to lean on it. And you need to be preparing that strategy, aka you need to be saving up that money 5 to 10 years out, 5 years out, so that you have got time to save it, because you're talking maybe 1 or 2, 3 years worth of other money. So it's going to take you a little bit of time to build that up. I think 20K is a great place though. And things like pensions, depending on working circumstances, if I stuck 20K in my pension and I was a full-time worker on a high rate, I'm going to get the tax back on that as well, which is going to boost that money significantly. And then you've got that to work. Also consider, Heather, do you want to retire? You say you're X amount of years from retirement. Have you set that goal? Could you work an extra year? Could you be part-time? There's loads of ways to make this work.
Would it be different if you were investing for like a longer time period than just, she said 10 years?
Yes.
Retirement.
So the hard thing about 10 years, let's say you have to retire in 10 years. The hard thing about the 10-year timeline is you both need to, and you haven't got anything, is you're in the accumulation phase, but you're also facing the period where other people would start to strategically think about how they approach the decumulation phase. If you're climbing the mountain, you're 3/4 of the way up the mountain, about to summit, and you've got to come down the other side. So it's kind of like you're in both.
Yeah.
If in an ideal situation, you would be approaching 50, 55, and you've got the majority of the money. But even then, even people at 50 who have been saving, say, since their 20s, most of the compounding will occur between 50 and 60. Because that's the nature of compounding. It's like a hockey stick, isn't it?
Yeah.
10% of the balance at the end is well more than the start. So even those people in their 50s are going to want to stay in the market and maximize
Yeah, the
returns.
returns.
They're not just going to want to be tapping the brakes, because that's when they're getting the most benefits from the effects of compounding. So yeah, I think the key thing is there, like 10 years is plenty of time. You can work longer than that as well. And just remind yourself that you're going to be investing in some way, shape or form until the day you die. So potentially there's 40, 50 years ahead of you there, which might even be more than you've had already. Watch the webinar as well, because, you know, straight from a financial advisor's mouth, much better than we could ever think up.
Billy wrote, I've just started my first pie on Trading 212. I'm invested in Vanguard S&P 500, NASDAQ 100, and Vanguard FTSE All World. Is that diversified enough? I feel I could be missing out. Thanks for everything. Your free course has really helped me get to this point.
I think, Billy, have you considered that you might be overlapping quite a lot there? So you've got the S&P 500, which is the top 500 companies in America, which is a lot of big tech businesses as well. The NASDAQ 100, a lot of big tech businesses. And then the Vanguard FTSE All World, which is the whole world, but 65% of it is going to America. I think if you looked at your portfolio allocation as a percentage, you're going to be about 80, 90% in the US market. So I actually think that you've, in an attempt to diversify, you might have overplaced chips on a single number. If you think about it like a roulette table, if you said, I'm going to put chips on the number 3, and then I'm going to bet in the first third, and I'm going to bet on the whole board, you end up putting loads on number 3.
Yeah.
You over bet on that number. So yeah, consider that. You've bought the world already, and then you've added in more America and then more tech in America. So yeah. And the free course is amazing. We'll link it below. But yeah, that I think, yeah, maybe try and find a way to look at the percentage splits. I think most people do this, don't they? They go, I can't decide whether I should have the S&P 500 or a global index, so I'll buy both.
Yeah,
50,
I did the same thing.
Yeah.
And that's cool, but then he also did the NASDAQ 100.
Yeah, even
so
more
he's just super exposed to tech stuff.
Yeah.
So yeah, I did both, because I'm like, I believe in America, but global gives me more.
But by doing that, you're actually more
doubly in America. Yeah.
So you end up instead of 65% America, which is the way the market is structured at the minute, you end up say at 80% by going 50-50. And I think a lot of people miss that point. But because the S&P 500 has done so well in recent years, you know, that strategy has actually worked. But that's not through, it's not like people understood that was the case.
It's just like you were eating both, you were eating from both.
You just so
plates
happen to be, exposed well to that market. But yeah, it's again, it's, you know, if that's happened, if that's worked for you, great. But if you didn't know that was the case and you weren't making that decision consciously, well, you just kind of got lucky. And if it swings the other way, are you really going to understand why? And you're going to be like, well, hold on, why is my global index down that much, but my portfolio is down this much?
Yeah.
Overexposure.
So would you say is he diversified enough?
It's funny because it's like,
it's trying to be diversified, but it's all in America.
I feel like his question is like, should I buy more?
Yeah.
And my question to Billy would be, should you buy less?
Yeah.
Do you need all of that? Like, why are you doing all of that? If you really back American tech or the American markets, then, you know, go for it. But I think it's kind of like he's thinking, oh, maybe I should add this or add that or add this. The benefit of a world fund is that you get everything.
So you're already just being in the world fund is diversified.
Yeah, because, you know, you have company risk, which is if I buy an individual company, the risk is that things go wrong, like the fraud, the Enron thing that we were talking about before. So, okay, I can expand that out to sector. And the sector is I buy every business within that sector. So I buy every energy business. But the threat then is that energy companies underperform, or we have a thing where airlines are all grounded. And even if you owned all the airlines, you can't escape that. Country risk is I'll just buy the American market. But what happens if America does bad? Okay, globally, I buy everything. There's nothing beyond that besides buying different types of asset classes. But when you start to bring in different assets into a globally diversified equity position, a lot of them will take away from the return. So like bonds, you know, you can dilute down the risk of them dropping, but you probably expect a lower return long term. So once you've gone global, you've kind of, they call it the only free lunch in investing, so that you diversify all of the individual risk away and you buy the whole globe. Like you own the globe. So, you know, you're going, I own the globe, I own America, and then I own tech in America as well. So you put a lot of chips
onto America.
Yeah. Go on then, next one.
And should people be worried if they just have one fund?
Do you remember when we had Romin on and he sat here and he said that he worked in an investment bank and with the brightest minds in the world? He came out and he had this crazy portfolio that was made up of loads of different funds. And someone in his audience was like, why don't you just buy a global index?
It's to say you did all that work just to be diversified.
To replicate the index again. You are just buying one fund, which kind of feels wrong because you're just buying like one product off the shelf. But when you look into the guts of what that is, it's buying thousands of businesses. So yeah, this is why they're a wonder product, because you can access all of that diversification, the whole market through one product. I get it, and it feels kind of wrong to me, but I only own one fund. I actually own a couple of different global funds, but that's because I buy through a couple of different providers. But in the main, I'm just buying a global index. Yeah. So yeah. I'm reluctant to sit here and say, yes, you can just have one fund because it sounds like investment advice. And someone might be like, well, my one fund is the FTSE 100, which is the top 100 companies in England. And that's not done so great for people in recent times. So, but you know, a global index fund is not a simple thing. It's a simple thing to buy, but it's a bit of a marvel of modern technology that you can buy one thing off the shelf and it replicates the global stock market. It's kind of like, you know, those films in the past where they used to put like a little pill in the microwave and out pop a Sunday dinner. You know, like just add water and it'd be like, boop. It's like one of those. So I don't think about what's going on there to make that happen. It's just if
you think about it, you got a global fund, you're investing in like India, China. For you to do the research to find out what's a good company to invest in India, what's a good company in China, in which sector, when to invest, like it's all done for you in a nice little diverse wrapper.
Yeah, and it might not produce the best returns in any given year. In fact, it won't. There'll be a particular country within that particular, you know, so if you buy the whole globe, you're just capturing the general kind of spinning of the earth, if you will. Every year there's going to be a country that wins, and every year the people who had that country will be like, I knew it.
Yeah.
But they're just kind of like the lucky ones. And for the longest time now, that's been America. But in the year that it's India, everyone will just start flocking to India going, oh God, we need the Indian. But with the global, you're just like, well, I got it anyway.
Hell yeah. All right, so we've got one last question. Very handsome listener's question from T Money. T Money says, it's me, by the way. He says, what is your advice? What would be the best advice that you wish you'd heard when you were younger about investing?
Do you subscribe?
I do, of course I do. And I like all the videos.
Get your phone out, prove it.
My phone's off because I'm professional.
Okay. I was going to refuse to answer it if you weren't. There's loads of bits, but you can summarize it like this, right? Investing won't make you rich quickly. It will take a while if you do it properly, because what you do is you take the money that you earn in your day job and you put that to work in the market and you let it compound over years. So the most impactful thing that you can do for your investments is improve the amount that you put in, you know, like improve your earnings. I would encourage people to not focus on the investment side and focus on the earning side for that reason. Too many people are like, which fund, doing this, doing that. They obsess over it for these tiny little percentages. If you buy any broad, you know, market index fund from any of the major providers and you slap it inside of a stocks and shares ISA or a pension and you do that consistently long term, you're probably going to be okay. The biggest thing that you can do is go and earn more money. Easier said than done, but I probably think it's easier for you to get an extra 2% from your job than it is to get an extra 2% from the market, if that makes sense.
Definitely.
So yeah, just set it up, forget about it, rinse, repeat for 30 years. And for some reason, watch finance content every week along the way.
And like and subscribe. And follow T is Making Money on Instagram. But I actually have some advice for people getting started, which I wish I knew. If you're new to investing and you're just getting started, what I learned is that it's really like intimidating and daunting at the beginning. And you're like you said, which fund do I pick? Which stock do I pick? When you should just probably go passive. But like, which stock do I pick? Which LISA? What do I do? As soon as you do the first investment, it becomes so much easier because you're familiar with it. It's kind of like riding a bicycle. You're like, I can't ride, I'm falling off. Once you like ride it the first time, you're like, oh, I got this. And then you learn on the job. So I think for me, you talked about like, make sure you put all the money from the podcast into your ISA, but I was not in a financial position to do that. I was like, I've got bills to pay, buddy. So I didn't. But then when I finally got around to it, and I'm like, open up my ISA, put money in. I'm like, oh, this isn't so hard. Like once you do it, and I set up my son's junior ISA, it's a lot less daunting. And then and then you start looking forward to it. Whereas before it was like, I need to invest. I'll do it later. Once you do it the first time, you're like, oh, that wasn't so bad. And then you kind of get encouraged to do it more.
Yeah, it's great that. And like, I think what I take away from that is you're going to be investing for a long time, and what you do in 20 years might not be what you do today. Just get started. It's like a fitness journey, isn't it? Or something. I think many people think, oh, if I stick 100 quid in, I might break it and somehow I'm going to end up like in prison if this goes wrong. But the worst that could possibly happen is you lose the 100 quid. And even that's unlikely if you're buying a whole market index like the S&P 500 or a global index, because for that to happen, every business in that index would need to fail essentially. If you're buying just shares in one business, the chances of that happening are much higher. So yeah, like, understand that this is a journey and that you're going to learn along the way and that you will make mistakes, and allow yourself to make those mistakes, and then it's okay. Don't think that you need to have it right first time, and don't let that put you off, getting started, like you say, T. It's pretty straightforward, isn't it, really?
Yeah.
The hardest thing is finding millions of ways to talk about it on a weekly basis so that people stay interested. So I brought you along, the most interesting guy I know. I was like, cool, you got to save me here, mate.